Are you struggling with high mortgage payments, but you want to avoid refinancing? Look, you're not alone. And here's the good news. There's smarter ways to slash your monthly bill that don't require restarting your loan or changing your rate. So a lot of homeowners don't realize there are actually smart, often overlooked ways to cut your monthly payment. And that's without touching your interest rate or starting your loan over. If you've built some equity, you've saved a bit of cash, or you feel like your property taxes are way too high, there are steps you can take to ease that monthly burden. You could be saving hundreds a month just by making a few simple moves. Here are 3 practical ways to lower your mortgage payment without refinancing. Number 1, if you've got a chunk of money saved up, you can apply it directly to your loan principal. Your lender then recalculates your payment based on the lower balance, but your interest rate and your loan term remain unchanged. No refinance, no credit check, and no starting over. What's great about this option is that it gives you a smaller monthly payment without the headaches of refinancing. No paperwork maze and no fees. You just need that lump sum ready to go. Now, what's the catch? Not every lender offers recasting, and even if yours does, you'll need to have enough extra cash on hand to make it worth it. Number 2, challenge your property taxes. Here's something most homeowners overlook. Your home might be overassessed, and that could be inflating your mortgage payment if taxes are included in escrow. If you think the county's valuation, or here, the parishes, of your home is too high, you can file an appeal with your loan assessor's office. If that appeal goes through, your property taxes and your monthly mortgage payment could go down for good. The upside here is real long-term savings. Lower taxes don't just help this year, they stick around. So you feel it in every monthly payment going forward. But the downside is that the appeals process can be a bit of a pain. There's paperwork, potential deadlines, and sometimes even the need for an independent appraisal. However, if your assessment is really off, it's going to be worth the effort. And by the way, the reassessment period and the appeals period is happening now in our parish, St. Tammany. Okay, number 3, eliminate PMI, or private mortgage insurance. If you bought your home with less than 20% down, chances are you're still paying PMI every month. It's a fee that protects the lender, not you, and it can add up fast. But once you've hit the 20% equity, whether you're paying down your loan or home appreciation, you can ask your lender to remove it. Once it's gone, your monthly payment drops instantly. What's awesome about this is how immediate the savings can be. Sometimes it reaches hundreds of dollars per month just by taking that extra step to prove your equity. That said, most lenders will want you to get a fresh appraisal to confirm your home's value, and they do need to approve the removal. But compared to the ongoing cost of PMI, it's often a very worthwhile move. If you're not quite sure where to start, I can help you sort through your options and see what works best. Whether you want help running the numbers or just talking through your next step, feel free to reach out. I'm here to help you make smarter moves with your mortgage and put more money back in your pocket.